Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 12.38% year to date. The stock market strength color signal is still green, and we want to beat the returns of the S&P 500 buy and hold investor. Their portfolio is up 14.54% year to date. So we are trailing behind them by a very respectable 2%, but ultimately before the year's end, we want to be beating that portfolio. Last week, the S&P 500, we do all of our measurements off of the Spiders ETF, symbol SPY, lost 0.83%. We are going to go through the charts in very great detail. You can see in the thumbnail that we've had now two red candles, and last week's candle is about the halfway midpoint of the previous week's red candle, which is a very normal pullback. So it would not be surprised for this market to go in either direction at this point in time. You can see that on the MACD, you have a negative divergence when you have higher prices here on the SPY and a lower high here on the MACD. MACD is getting ready to cross below its signal line here on this weekly candlestick chart, and the slow stochastics is already below its signal line, ready to drop down, indicating further weakness coming up in the intermediate term. Last week we made one trade. So the trade that we made on 7/22/24 was we placed a call. I thought that the market had bottomed short term and it was going to be bouncing, but the very next day it started to deteriorate after this call. So I am upside down in this position. So here's the positions that we have in place right now. We currently hold 200 shares of SPY. We are profitable in that position by $11,338. We also have an in-the-money covered call, and for 200 shares, so the entire 200 shares that we have, we're in the money covered call, and the way that the in-the-money covered calls works out is that we sold them. So we sold those calls, and that's why the yellow purchase price here is highlighted, because that position has not been closed out yet. That's still an open position. And so since that's still an open position, I highlighted the yellow cells to indicate that they're open. Now, when we go to either we're going to let this option expire and we're just going to let the shares get taken away from us, depending upon if we're trading at 490 or below 490. But if we are trading above 490 or at 490, I have the option of just buying to close this covered call. And that would be the purchase price, because we would buy to close. So in that position, we're profitable by $180. I also put on a put, one put, and I put that on 7/1/24, the same day as the in-the-money covered call. We are currently profitable in our put position by $39. Now, the call that I put on, I'm upside down on that one by $388. So and the length of time on the expiration, I'm going all the way out till June of 2025. I believe I'll have plenty of time to close these out profitable, both positions profitable, by the time June of 2025 rolls around. So I'm not really sweating anything. And that's where we currently stand. If we were to cash out our portfolio today, we would be profitable year to date 12.38%. Not bad. Here is the equity curve for our model portfolio in blue and the benchmark S&P buy and hold investor in pink. You can see that over the last couple of weeks, the buy and hold investor has softened up, reasonably well. And we've did soften up a little bit in week one, but here in week two, we actually went positive. So that's good for our portfolio. I'm positioned the portfolio so that The further the S&P 500 goes down, the more our portfolio will profit and go up. But because I have one call and one put, they're kind of going to balance out a little bit right now until I close out these positions. My expectation is I'm not going to close out my call or my put until later, and they are going to be profitable when I do close them out. Now, here we are looking at a 6-month daily candlestick chart for the S&P 500. Now, clearly, we are in a downward trading channel highlighted by this blue line and this blue line right here. We are trading, we are stuck in this trading range until we break out of it one way or the other. Personally, I think we're going to break to the upside out of it. All right, so this line here we're calling a valid trend line based off of that low and that low right there. You can see how I tagged the both of them and then made the line here going across. We are now trading below this line right here. So we're trading below the valid trend line. But now we are trading, obviously, here in this trading channel here. I think that we're going to break out and possibly come up and tag the underside of the VTL before we start traveling back down and then go even further than that low right there. None of that has happened yet. We're still, until we break out of this trading channel, we are stuck in it. And so we have to have an expectation that we're going to continue to trade in this downward channel. Now, we do have a cycle right here, and then there's a cycle low right there. That cycle low comes up to right about here-ish. So we're getting closer to that cycle low. Either this one may have come a little bit early, or we're still going to experience some more softening, come down before we bounce up. We'll have to see how this whole thing plays out. We don't know exactly how that's going to play out yet, but that's where we currently stand. We do have an oversold condition here in the slow stochastics. So we're in oversold territory. If we go and get that bounce, also MACD is coming down here towards the 0 line. So it's possible that we've kind of neared, this is about a 5% correction right here. So 5%, a pullback, I should say. This 5% pullback is normal and healthy. So it would not be surprising. Find support where it's kind of right here, almost at this red line, which is a previous gap low down there. We pretty much just about filled the gap. We'll see if this continues to go up. Now we are looking at a ratio chart. NASDAQ 100 to the S&P 500. Risk off. Look at it, drop like an absolute rock. Usually it doesn't drop quite so dramatically in such a short period of time, but it did. MACD way down here, slow stow, oversold. So it wouldn't be surprising to get a bounce here. Now we are looking at the VIX Volatility Fear Index, 3 levels. This green level here, above that is the upper range. Between this green level and this green level, that's the low range, which is still bullish. Below this green level here, that is the ultra low range. Where are we at? We are right here at 16.39. Anything below 20, generally speaking, is going to be bullish. So we're still in a bullish configuration on the VIX, although we did come up, and look what happened when we went from the ultra low range to the low range. The S&P 500, which is here in blue, you can see it highlighted here, SPY, did drop during that time frame. So when the VIX goes up, when the VIX goes up, the S&P 500 goes down. Now, seasonality for S&P in July, going back 5 years, 100% probability you're going to close the month profitable. In July, going back 10 years, 100% probability that you are going to close higher than when you opened the month. Where are we at right now in the current month of July 2024? We are up 0.04%. Well, probabilities stand that you're really going to not drop and, if anything, go up from here, from this basis. All right, now we are looking at a weekly, 3-year weekly chart for the S&P 500 with our cycle brackets down here. And I also have the Fibonacci right here to show us kind of what's going on. And so that is going to be this one right here, which is the Fibonacci extension. And I grabbed it based off of this low to this high to this low. As I move over this cursor here, you can kind of see it highlighted. We just about tagged the 61.8 before we got rejection, and now we are traveling down. We do have a VTL, which is right here based off of obviously that one, that low, and that cycle low right there. So and this cycle is based off of this cycle here to that cycle there. That cycle is positively configured, and we have a VTL, and although we did drop below the VTL intra-week, by the end of the week, we closed above it. So we are still trading above this valid trend line, telling you that you are still bullish based off of a weekly time frame. Now, I also have in here standard deviations. You've got the +2, -2 in gold, +1, -1 in pink regression line at the dashed green line right here. Currently, where do you stand? You stand right there, which is about 1.45. So it's there's a 96% probability that you're not going to exceed 2. So we have room in here to bounce around, but there's more room for it to go down than there is for it to go up. But that does not mean you can still come up some. So it can juice either way. But if you start breaking this VTL, that's going to be further evidence that this market is in more of a decline. So we are going to monitor that. Let's go ahead and switch over to the daily chart. We're going to go to the 1 year, 1 day, change our cycle brackets to daily, which is right here. And as we look at this, and let's just get a nice blow up of that so you can see it really well. As we look at that, and I also have the Fibonacci extension that's right there as well, based off of this low to that low right there. We just about tagged the 78.6 before we got rejection. You can see that we're trading in this trading channel right here. So we know that we're going down. Now, what I'm going to do is I'm going to remove that. We're going to put in another Fibonacci retracement. And we're going to grab it from this high right here. Now, if that is the low, let me just blow that up real nice. If that is the low right there where I dropped it, well then now we're looking for the bounce. Now the question is, how much and how far of a bounce are we going to get? We don't know the exact answer of how far we're going to get, but hypothetically, if we get a 50 to a 68.1 retracement on this bounce and then start to hit resistance and then come down, then that tells you that this market is changing. If this bounce goes up to the 78.6 or up to the 100 or anywhere passing the 78.6, that's telling you that there's more strength left out of this market and that this was just merely a pullback. So how this next advancement plays out is going to give you information on what's going to happen in the future. We need to see at what point in time this advancement is going to cut out. Now, I've got a couple of alerts that are going to be sent to my cell phone as they come into play here. So one of the ones here is at 542.52, which is this low right here, this cycle low right here. We did get below that, indicating that this is a cycle breakdown, but now we're trading above it. If we go back below it, that further confirms that this next cycle is now a cycle breakdown, and that we are that this cycle here is breaking down compared to the previous cycle. Okay, so then that would be negative. That's telling us, okay, we are definitely heading south faster than we anticipated. If we start breaking out above the 554.63 or thereabouts, and we start going up into this area over here, especially at 559, 560-ish, well then that's telling you this market has more legs into it. Even if it comes up, comes down, it's probably going to go back even further up and take out that old high. So we need to see how this whole thing plays out. You guys know the positions that I currently have on my portfolio and I'm also positioned to take advantage of more downturn over the next 3 months. Mind you, this is my positions are in play for a 3-month time frame, not a 1 week or one day or whatever time frame. That's basically, I'm going out, good amounts of time. So no stress on the portfolio. Everything is fine. I want to see how this thing plays out, giving me information. Now, if this market does come back up to the 61.8 or the 78.6, I expect to hit resistance somewhere in that neighborhood and then begin to crash down. And right here on this candle, this is the one where I placed my call. See, what happened was the market came down, then bounced up, and it looked like such a good bullish candle. I thought it was going to continue, and it did not. The very next day, it got that rejection candle and then a gap down. Well, I did not close out that call. Probably should have closed it out the very next day with that rejection candle, but I held on to it, and I'm upside down in that a few $100. But if we come back up, and I do anticipate us to come back up and come into this neighborhood again, and then I'm expecting some type of resistance and then possibly more of a rollover, well, I'll close out. As soon as my call gets profitable, I'll probably close it out just because I don't want to take a loss on it. Okay, now we are looking at an Excel spreadsheet that I created to try to give me some information about the health of different asset classes and the health of the 11 S&P 500 sectors. Basically, the more green on the screen, then the better off you are going long. Notice what you see immediately. You see the 11 sectors of the S&P 500, majority of the sectors are in green. Who is not in green? It is going to be technology and communication. So the money is rotating out of these sectors and into the sectors that were less favorable. That's why you have so much green going on your screen right here, and we are still green in our portfolio. As a matter of fact, last week we were at 76. This week we are at a health of 77. So even though the market corrected down, it rotated out, and you are still have a lot of healthy sectors here in the S&P 500. Can't say so much for the asset classes. Last week we were at 70. This week we're at 59. Well, as soon as you get to 60, between 26 and 60, you're going to be a yellow. So we changed from green to yellow on various asset classes. You can see we got equities, real estate, precious metals, bonds, emerging markets, and outside of the United States, symbol VEU. So all of these things are telling us that, there's definitely weakness amongst various asset classes. But when it comes to the S&P 500, where our portfolio is really concentrated on, we can see that what we have is more of a rotation. Now we are looking at a 1-year chart for the 10-year bond yields. Where are we at? Well, we are right here. We are at 42.00. Well, the market can live with that. It is going to advance. Now, in blue, this is the S&P 500. We did correct down, okay, but it looks like we've hit a bottom and we're going to bounce up, which will be further evidence to see that exactly what I was telling you about, how we're going to get that bounce into those numbers that I showed you at the previous screen. Okay, that is the video. Now comes our critical thinking. What are you going to do with that information? Well, as of July 27th, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now, the market strength is rotating out of tech and into other sectors. Fear is increasing, but still below 20. July has a very strong seasonality, and we are only up 0.04%, and we have a half of a week left to go. I am expecting sideways to up action over the next 1 to 2 weeks. Our positions are in place, and now we watch the market action. I gave you some key levels to watch. On the low side, 518.36, and on the that's for the low side, and 554.77 on the high side. You start taking this out, you're going higher. Start taking that out, look out below. So that's what we want to keep an eye on. I hope you got some valuable information out of this video. If you have not done so already, hit that like button, subscribe to my channel, and ring that bell. I thank you and wish you good trading.